The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick. These are your headlines. Investors ride the chip rally with equity markets in Asia and on Wall Street boosted by blockbuster earnings out of Micron and SK Hynix's plans to raise almost $30 billion through a Nasdaq listing.
Brent prices fall to levels last seen before the Iran war as oil begins to flow, whilst futures contracts show the global economy may be facing an oversupply. How extraordinary in the short term. And UK Prime Minister hopeful, it's yet to be coronated, but yes, indeed, hopeful. Andy Burnham is reportedly planning a major overhaul of Number 10 and the Treasury as part of his economic agenda, whilst also seeking to reform the Bank of England's mandate to place a greater emphasis on growth.
Let's take a look at chips again, because it was certainly a bumpy ride yesterday, and now shares in SK Hynix surged following the company's announcement that it's looking to raise up to nearly $30 billion in a listing on the Nasdaq. The chipmaker said the move would allow, quote, its true corporate value to be properly evaluated. Trading is set to begin on the 10th of July, although the company warned that the timetable could still change. Well, it doesn't matter. I mean, there's already so many links between South Korea and also the United States. So bringing another chip name across to the US markets, what does it mean for those investors? Feels like they're already part of that ecosystem. Now, Micron shares are surging in extended trade. The memory chipmaker delivering a blowout quarterly report and crushing estimates for fourth quarter sales. In a statement, the company said it now expects revenue of about $50 billion in the current period, up from $11 billion a year ago and well ahead of forecasts. The US chipmaker is also unveiling that it has secured $22 billion in commitments from 16 strategic customer agreements. The stock price is up almost 700% over the past year. In the last 24 hours, CNBC has spoken to a trio of executives focused on the AI trade. And despite the recent volatility in tech stocks, one major theme kept coming up.
But one thing that I think is also very important to highlight is why. Why do we need so much compute? And I think we're heading to a world where the economy is really shifting to be AI and compute powered, that is going to be a force that really lifts up what everyone does.
Compute demand among our 6 customers, and as I say, we only have 6, and OpenAI we count as obviously a one critical customer, is simply insatiable. It's just much more than we can address.
We have dozens of customers that are demanding huge amounts of compute. OpenAI is obviously the largest. In addition, we signed and will soon be delivering compute for AWS. Customers like GlaxoSmithKline, we do a big business with the US Department of Energy.
Microsoft delivering a lot of devil in the detail yesterday, Micron rather, and what you saw was fascinating. The company has inked 5-year term take-or-pay agreements. So just repeat that, 5-year term take-or-pay agreements. So the industry hasn't done this before. It is telling us that it can see the demand for a long way out down the runway. It's telling the customers that if they want the demand, they want the supply to meet their demand, they have to sign up for 5 years with a contract that means even if something changes in the foreseeable future, that they pay to take delivery of those chips, or they pay, so they're on the hook. It's not Micron that is on the hook. So I think there was a crucial detail yesterday, in addition to the numbers coming through and beating expectations in the quarter, beating expectations in terms of forecast. I think the market was very happy with that. The one pushback I would have here is that the technology is changing at pace. And Qualcomm had a separate announcement saying effectively that it's trying to design chips and that it's come up with a design that means cheaper memory. So again, putting a limit on some of the demand that, again, is a big feature here. The big demand's coming through on memory, the other is on energy. So the technology is changing quickly on those two fronts.
Very smart of Micron to try and get the longer term contracts, because they know everyone knows, all our viewers know out there, you know, that memory isn't like, it's a commodity. It's a commodity where there's been a complete and utter balls up, where people thought it was all about GPUs. Actually, it's about CPUs as well. They thought it was all about the advanced chips. It's actually about the bog standard chips as well. So that's why their margins absolutely surged from 80 to 84.9% from 39% a year earlier as well. And they will go back down again as well. That's where the market skepticism comes in about the longer term story. That's why Micron and SK Hynix and Samsung, despite their meteoric rise, haven't actually kind of got massive long-term multiples, because everyone knows. So tying it in for the longer-term future, very smart as well. The customers will potentially be tying themselves in here at prices when actually we all know that because it's a commoditized product, the prices will go back down to here as well. So very interesting as well. But let me go back to the fundamentals of what's going on as well. It was very interesting listening to the two gentlemen we heard there from Cerberus versus Hock Tan from Broadcom. And it was the Broadcom comments that I thought were amazing. The demand from our 6 customers, he said, is amazing. From our 6 customers as well. And therein lies the issue as well. Those 6 customers are buying the chips and they are hoping that they turn profitable in the next few years as well. And then we're in the sunny uplands. But the fact of the matter is, these companies are still losing vast amounts of money. Now, those unaudited results that were leaked about a week ago from OpenAI showed the scale of the losses is enormous. The losses being built up are enormous. Can they get to scale? Can they get to profitability before the product becomes commoditized? And that is where the oscillation is going to continue in the market.
And let's put a few more pieces together here too, because one of the other stories we were discussing yesterday was the interest rate scenario that Bank of America dropped in everybody's inbox, that they see a couple of rate hikes this year versus the dovish scenario.
I think it was 3, wasn't it?
Right, exactly. Yeah. 2 to 3 was the scale. There's an increasing awareness now that inflation may have been triggered because of this huge AI build out. The $741 billion this year from the hyperscalers, from the chipflation story that effectively starts with Micron, SK Hynix, Samsung, spills across to all the consumer devices, even to Apple, that has flagged that there are going to be price rises as well. It's in a lot of the other consumer devices. So there is a view that that chipflation story could spill across to broader inflation in the economy, because the build out is touching a lot of sectors. It's hardware, it's physical, it's infrastructure. It could actually have some bearing. UBS is talking about at least a couple of years before AI could start to lower inflation. So to the point of what we've seen from the Fed now to some of the forecasts from banks, there might be a period of more elevated inflation because of these AI factors, not because of the Middle East anymore, but because of AI factors. Before then, we get to a world of lower inflation. So if you think about the consequences of that, central banks, do they have to put up interest rates short term to conquer some of those inflation expectations? What does that do to the backdrop where we are hoping it's a benign credit environment to get everything funded? But what if it's not because of the same triggers here, because of AI?
I think our viewers are very interested to know that, well, they're basically, and the other point is as well, is that the industry is raising a lot more money. We talked about that US listing, we've talked about the big hyperscalers raising vast amounts more money. We've talked about the money that's been absorbed by SpaceX and the subsequent bond issue as well. It's getting harder, if you are a passive investor, to hide from the AI story as well, because everything's going to get sold out during these periods of oscillation onto the downside, and everything's going to get bought up aggressively on the way up as well. But if you're looking for a port in the storm, it is very, very difficult to find that now, whether you're investing in the Dow, because we've got another tech company going in, if you're investing in the S&P because of the predominance of those companies, and certainly, of course, in the Nasdaq. And we've seen the kind of oscillation we're seeing in the Kospi as well, which is moving, 10-15% on a day, and no one's even blinking these days. For more on the detail on the race to secure AI infrastructure, check out Kai. Our very own Kai has got a piece on CNBC.com.
Well, let's take a look at those US markets and the action that we saw yesterday stateside. I mean, the Nasdaq performance, again, weaker. There were moments of strength, but again, some of the concerns around the chip stocks still evident. Down 0.4% as we closed out the trade. Microsoft, actually the big mover to the downside for the S&P 500 and the Nasdaq, which was some irony because it was Microsoft itself that sparked some of the selling. We talk about other models using some open source technology that could mean cheaper compute. So that was actually one of the triggers for some of the market market sell-off this week. In terms of the Dow, it was stronger, so going in the opposite direction and on course for gains this week of about 0.5%. It was Home Depot that was at the top of the charts yesterday for the Dow. The Asian markets and the session that we're watching today, we are again talking about some chip strength that has come back into the mix. Micron helping to still some of those concerns in the region around SK Hynix and Samsung. And those two companies coming up with their own news flow, the likes of Samsung around a buyback, SK Hynix around an ADR listing stateside. So they are putting the positivity back into their own stocks in addition to some of those fundamentals from Micron. We've got the South Korean market as a result shooting ahead 6% going with it. The Japanese stock market more than 4% in the green, but left behind the Hong Kong market, as you can see, down 1.6%. Well, European futures, the early picture this morning in the back of what were gains for the FTSE 100 of about 1/3% and gains for the French market a little bit more than that, offset by some selling on the German stock market that was well and truly left behind yesterday. It looks as though we might see a flip to that story where the FTSE futures are indicating a downbeat session, but the DAX is looking to pick up a little bit of steam today. And stateside US markets early hours, this is how they're looking, all perched higher. It does actually look like the Nasdaq may see some confidence in those Micron numbers, looking to get ahead today at more than 2%.
Oil prices trading lower this morning with WTI below $70 a barrel as transit through the Strait of Hormuz ticks upwards, easing supply concerns. WTI and Brent hovering around levels not seen since before the start of the war. I'm going to dispute that. You got the actual day the war started, but did anyone not spot the fact that you had these ruddy great carrier fleets moving towards Iran or certainly that region in the days and months up to? So can you actually say, the day the war started is how it was? I personally dispute that. I think the prices was dramatically lower before the drumbeat of war began in December onwards as well. Anyway, that's just me being pedantic, perhaps. Anyway, the Brent futures contract for September and October are currently trading higher than August, indicating the market is pricing increased near-term supply, but fewer barrels of oil in the months ahead. On a programming note, our US colleagues will be speaking to the Energy Secretary, Chris Wright, this afternoon. That conversation at 3:30 London time. And traders will be watching out for, not just traders, all of us, watching out for the PC data for clues on the Federal Reserve's next policy move. Forecasters expect the index to show inflation hitting 4.1% in May, up from 3.8% in April, and the highest reading since 2023. Financial markets are now... What do financial markets know? What do they actually know? Come on. Pricing in a 32% chance of Fed hikes rates by 1/4 basis points at its next policy meeting. Shouldn't we just say it's a 68% chance of an hunch? Shouldn't we say that? I don't know. According to the CME's Group Fed Watch tool. Anyway, speaking to our US colleagues yesterday, I think it was just one of them actually, Treasury Secretary Scott Bessent said he's confident the US economy can achieve 3% growth this year.
We went into this on very strong energy footing, on very strong CapEx cycle from both the AI and the tax bill. The U.S. economy has really performed, and we're going to get to the other side of this conflict, as you were just showing. Energy prices are coming down, inflation's going to drop, and the economy, I think, is going to be accelerating on a non-inflationary basis for the rest of the year and for the rest of the president's term.
Mike Hunstad is the president of Northern Trust Asset Management. Mike, lovely to see you. Thank you very much indeed for popping by on your very busy schedule to see Karen and myself. Look, Mike, I was making the point before you joined us on set that it's getting harder for people to avoid being exposed to the AI trade, even if they don't know they're exposed to the AI trade as well. Now, that might be great. They may be what they want. They may be what they should have in their portfolio. But are you hearing some of that from your clients as well? It's like, how much of this have I got? How much do I want? How much should I have as well? Especially seeing as I think your VAR is picking up on the basis.
Yeah, there's definitely a big question around the SpaceX IPO of how much should you have in your portfolio? The reality is that, to your point, everyone will own some at some point. The challenge is, what is the amount at which the indexes, the various indices, will actually reflect the SpaceX CapEx? The SpaceX float. Yeah. And the challenge is very different across the board. So some methodologies have it based on the amount of float that's out there, which is only about 85 billion. Others will adjust later, such as the S&P. So a year from now, that float may be significantly higher. So I think you just have to be concerned about, what is the methodology with which an index reflects that stock or those IPOs within their benchmarks.
Yeah, look, it has nothing to do with me, what people do with their money. I'm not an advisor and I don't give stock tips. But if I was thinking about this logically, I would probably be avoiding the higher price, higher expectations AI exposure and thinking about which customers are going to benefit the most from this as well, looking at the derivative of as well. Yeah. Is that a trade that people are, or a thematic that you are looking to explore?
So I think there's a lot of retail sentiment around these IPOs currently. That means in general that there's a lot of near-term momentum around them as well. The reality
I don't want to lose that noise. I'm not a trader. I'm not a gambler. I'm an investor. How do I?
From a fundamental perspective, there's a challenge in the context that whether you look at the price to earnings or price to profitability perspective of these stocks, at least SpaceX, it's a big challenge. It's a big question mark. Yeah. So from a longer term perspective, there may be downward pressure on the SpaceX price. But given that there is today a lot more animal spirits in markets than there has been in the past, driven largely by the fact that price discovery in markets more and more seems to sit in the hands of a retail investor, the momentum trajectory of these stocks, at least over the short to intermediate term, could be quite positive.
Let me steer you over to chips, because to me they are the derivative of. That's where the market has been positioned, because the hyperscalers are spending the money, to your point, all the concerns Steve mentioned earlier. The chips have had the contracts, they've had the money rolling through, some in particular when it comes to the high bandwidth, the memory. That's where you've seen the gains, and Micron again reinforcing that overnight. Do you want to steer away from that? I mean, we've heard conversations this week, it's time to diversify. I mean, look at the equal weight. But if you look at the equal weight S&P 500, it's up less than 10% so far for the year versus semiconductors up 100%. Yeah. So even if you get some bumpiness on that 100%, you're still pretty much ahead. Yeah. So it's almost a mistake to be diversifying because you're leaving so much on the table.
Well, let's look at the forward view as well. So technology stocks, earnings expectations over the next 12 months, almost 70%, 65%. Very, very healthy. Equal weight on the S&P, still relatively healthy at about 30%. So I agree with you that there's a lot more upside potential to the technology sector. Given the fact that it's outsized relative to the equal weight benchmark, I would not underweight at this point. Within our portfolios, we're risk on. We're very bullish on tech overall.
So how do we recalibrate now around the risk of inflation? I was just fleshing out at the start that I think there are concerns. I mean, the Federal Reserve has just turned slightly more hawkish. We've seen some of the banks break ranks around the potential for rate hikes this year. And as you look at what inflation is doing right across the economy, not just to the chip side, but elsewhere in the infrastructure layer, it is causing some extra heat in the economy. Yeah. Is that going to bring anything unstuck in the near term?
I think one challenge is Warsh has not really given a view on the inflation dynamics within the economy as of yet. I think it's very uncertain what his trajectory is going to be. We heard Bessent talk about AI being a potential deflationary impact on the economy. But when I look at what I think has a lot of information content is break-even inflation rates. 2-year break-even inflation has gone down considerably over the last several weeks. 5-year break-even inflation is about 220. That's right where we want from a policy perspective. So I think what the market is telling us is that there are certainly transitory factors embedded in current CPI prints, and you just saw that a minute ago. So normalizing to something slightly above a 2% over the intermediate term is exactly where we think we need to be. I think that puts a little less pressure on the Fed to actually cut in July, maybe in September, but our bets are actually on no cuts this year.
To me, these transitory impacts, though, are backward looking. We've translated from one transitory element here to the next transitory. So we had tariffs and then we had the Middle East. But the next transitory, but maybe not transitory factor is AI. Yeah. And so how do we think about the imports that could have near term for the next 12 months to 2 years?
I think AI could have a potentially massive deflationary impact on the economy overall.
Beyond 2 years, though?
Beyond 2 years,
but
absolutely.
Not in the near 2 years.
It's hard to say within the next 24 months. I think there will be an impact, and part of it is when you listen to earnings calls across the economy, almost every CFO is talking about investing in AI and potential productivity gains from AI. So even if we come in, let's say, half of what our expectation might be from the rhetoric of these earnings calls, it's still going to be significant. Depending on who you listen to, the productivity benefit, now granted this is intermediate term, is anywhere from, let's say, 10% to 50%. Those are big numbers, even in the lower end of the range. So I think AI will be, have as much impact, and I know this is a big statement, as much impact on inflation and economic growth as anything that the Fed will do in the intermediate term, because that's how powerful it will be on margins and ultimately how powerful it will be on real economic growth.
It's like sitting with Kevin Walsh. Kevin Walsh looking back at a Greenspan paper from the middle of the 90s. Mike, I'll move just slightly on. Well, no, I won't actually. I'll follow up on that one as well. Where's the energy going to come from to power this? Because Karen knows, I know, everyone I speak to knows that we have a massive deficit of connected electricity to pay for this stuff.
Yeah. Well, the reality is that at least the U.S. power grid has not been fully, call it, invested in over the last couple of decades. That's why you see utilities earnings expectations, probably the highest that I have seen them in my career within the industry. I think that it's call it a near-term issue, that there will be more supply coming from nuclear, more supply coming from really all sources to fund this. So I would say it's a bump in the road, but what the market is telling us, they're not discounting that as an obstacle. That when you look at all the earnings expectations on AI stocks and all the downside risks that potentially could be there from an energy perspective, it's still very optimistic.
Help me out here, Mike. I'm that Northern Trust asset management client. It's hypothetical client. I'm not, by the way, but I'm a hypothetical client. Maybe I should be, but I'm not. I'm probably not rich enough. Almost certainly. I am that hypothetical client who's like, listen to everything you and Karen have said. It's like, yeah, I don't like it. I'm really suspicious. Those valuation concerns you had about the oscillation because it's the retail investor leading a momentum trade, you've said all of that. I don't want it. Where am I going to go?
Here's the problem.
I want you to make me money, but I don't want to be involved.
And that's exactly the problem. That's exactly the question you should be asking.
Thank you.
But the challenge is that if you bet against technology overall, U.S. technology in particular, you're betting against the highest free cash flow, highest profitability, some of the best balance sheets in the business.
I'm Warren Buffett. I'm actually, I'm just such an old-fashioned guy. I want to see profits. I want to see cash flow. I want to see dividends. I want to see real income. I know, I get it. I'm just a curmudgeon. I'm sorry. I'm not saying Warren Buffett's a curmudgeon.
On the sidelines, holding a record amount of cash. That's what you're doing right now, Buffett-esque.
Have you seen the money he makes? Throws off cash.
But he's been in cash while this has been playing out.
Earning a solid percentage on that in the meantime, and he's in great American companies. Sorry, please, where do I go?
No, absolutely. Even if you take out the tech sector from equity benchmarks, earnings expectations really across the board are still very attractive. Yeah. We are risk on in our portfolio. We're overweight equities in our portfolio, partially because of technology and the AI trade. But even when you look at earnings expectations in rather more ho-hum sectors like materials or industrials.
But that's okay, Mike, because, sorry, I know you're going to come in, but that's okay, because I'm that investor who knows that these are the ultimate clients of the AI adopters, of the hyperscalers, of the large language model developers. So I know that if I'm in ho-hum, your words, love that word, ho-hum, for industrials, ho-hum for materials, ho-hum for some of the traditional energy players, so ho-hum for for Walmart. I'm ho-hum for railroads, but I know that AI is going to change my world, so I'm okay. I'm okay with that, but I don't want to own the hyperscalers. What do I do?
Yeah, so you made the point about equal weight.
Yeah.
If you're cautious about technology, but still look at the equal weight, so across the board, across every company within the S&P 500, your earnings expectations are still 20%. So
I can live with that.
Yeah, exactly. So I think more than enough reason to be exposed to equity overall. The natural inclination is to say, okay, equities, are they overvalued because of technology? Well, if I believe that, then the propensity is to move potentially into fixed income, move into kind of more alternative asset classes, if you will. My point is that that's, I think, a knee-jerk reaction that need not be the case.
Well, Karen will comment. This is a great. Thank you for this, by the way. But even it as, and you answered in your second or third question that that valuations are being driven by a new echelon, which is the retail investor. It's not being driven by the smarty pants on Wall Street or up the road here in the city of London. Right? It's being driven by the retail. Doesn't that just ring a tiny weeny little alarm bell for you?
I think it does in the sense of near-term volatility, but that's the price that we pay for being equity investors. I think overall there is tremendous potential. Again, 65, almost 70% earnings expectations in technology. You can't discount that enough to say that, hey, I don't want to be in the technology sector. I don't want to be in equities as a result of that. There will be volatility. There's no question about that. But overall, at the end of, say the next 12 months, would I have preferred the volatility of equity exposure given the technology play versus fixed income? Yeah, probably will be better off at that point.
Mike, thank you so much for joining us.
Great.
We do appreciate the time. Mike Hunstad with us, President, Northern Trust Asset Management. Coming up on the show, extreme temperatures continue to grip Europe. We'll have the latest details. Plus, fundraising for AI is set to pick up. We'll discuss which areas might be set to benefit this hour. And we'll be speaking to the CEO of MSCI, Henry Fernandez. Don't miss that conversation, 8:30 BST.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Extreme temperatures continue to grip Europe, with authorities issuing red and orange warnings and taking additional measures to protect people. In southern England, temperatures officially reached 36 degrees Celsius, setting a record for June. Meanwhile, in France, scorching temperatures are forecast for most major cities today. And through the end of the week, at least 50 people have died since the onset of the heat wave. Major landmarks such as the Louvre and the Eiffel Tower announced early closing times. Schools have also been shut, while nuclear power plants cut output by 7% as extreme weather limited access to cooling water. Charlotte joins us with more. Charlotte, there are many questions here. One, of course, if this is June, what does July and August look like? Because typically this is not the hottest month of the year.
No, already the second heat wave. And as you say, summer started just a few days ago. There is a concern that the intensity and the regularity of these heat events are happening. France having their hottest day on record since the record began nearly 80 years ago. Record for Paris at 40.9 degrees. So France was hotter than around 99% of places on Earth, apart from Death Valley, the Middle East and the Sahara Desert. So this real bubble, this omega block that is stagnating over the country, and that's the reason that they just don't know how long it might last because of this weather pattern. But that has some echoes to the 2003 heat wave, where there was an excess, 15,000 excess deaths in the country, around 80,000 in Europe. There's some measures have been put in place, but there's a concern around why no more measures have been put in place, more preparation happening. So as you say, a lot of disruptions. Thousands of schools are closed or closing early, transport being disrupted, landmarks being closed. The head of the MEDEF also saying earlier this week that France is operating at reduced capacity. And, looking at the economic impact, it's hard to evaluate. There's been some studies out there. The credit insurer Allianz Trade did a study looking at the warmest day between 2014 and 2024, and reproducing this for 2030, and said the cumulative GDP losses would reach between 5 and 7% to the most exposed European economy, France being one of them. And so they know that Europe is warming at more than twice the global average. And that's the concern there on the impact on multiple fronts. One area from France that is being watched is agriculture. France is the EU's largest grain producer. There's concerns about the heat wave, the impact on maize crops during a growing season, and wheat as well. And we see the futures for both maize and wheat. Higher impact on milk output as well. There's some heat stress on cattle as well, on on that front. So they're watching all these. Thousands of poultries have died as well. So that's on agriculture in particular. That's having a political impact in the country. The far-right leader, Marine Le Pen, talking about how it is absurd to have people die because of the heat, that if she's elected president, of course, the presidential election is next year, she would put in place a massive air conditioning plan, starting with place with most vulnerable population. Of course, the left then responding, saying, well, that would add to the problem. Air conditioning is not the solution, it's adding to the problem. We need to look at more long-term with regulation, with more environmentally friendly policies. So that is the tit and tat there. We know the Macron administration was very pro-environmental policies in his first mandate. There's been some rollback on some of the policies over the past few years, all in the name of keeping Europe competitive. So some regulation has been slower to roll out as well over the past few years, even though some billions have been earmarked on that front, but red tape, etc., adding to the problem. So that is the situation in France today. Still, most of the country under red alert. And as you're saying, going further, the regularity of these events impacting things just like tourism. People are changing the way they're going on holiday. Used to go to the south of Europe, whether it was France, Spain, or Italy. People are changing their plans, or they go to these countries at different times, whether it's Easter, October. But when it comes to August, you think twice now because it's absolutely sizzling.
And at the other end, the ski season's changed completely. Thank you. Thank you very much indeed for that. For more on how France is coping with the heatwave, as well as some recent power outages, head to CNBC.com. OK, let's take a look at the European equity futures as we go to break. The stocks futures seen higher, the FTSE futures seen lower. Again, that's a knee-jerk, I guess, on the energy plays in the London market. And the DAX up 0.2 after the drubbing yesterday for those defence stocks.